Silver is often dismissed as just another commodity, but that misunderstanding is exactly why it matters so much right now. Silver is not simply a shiny metal traded on a screen. It is a strategic asset that connects history, economics, and the future of technology. For thousands of years, silver has functioned as money, a store of value trusted across civilizations when currencies failed and empires fell. That role never disappeared. It was only temporarily overshadowed by paper systems built on confidence rather than substance. Unlike digital assets or printed currency, silver exists in the physical world and obeys physical laws. It cannot be created by policy decisions, interest, rate changes, or political pressure. Every ounce must be mined, refined, and transported, a process that takes time, energy, and real cost. This makes silver fundamentally different from assets that can be expanded at will. Scarcity is not a theory here, it is built into the metal itself, and that scarcity gives silver its strategic importance in uncertain times. What makes silver unique is that it is both a monetary metal and an industrial necessity. It is one of the most conductive materials on Earth, which is why it is embedded in solar panels, electric vehicles, medical equipment, advanced electronics, and defense technology. Modern life increasingly depends on silver, yet much of it is consumed in ways that make recycling difficult or impossible. That means demand doesn't just grow, it permanently removes supply from the market. This creates a powerful imbalance that few people are paying attention to. While global industries rely more heavily on silver each year, mining output struggles to keep pace. New discoveries are rare, extraction costs are rising, and much of the silver produced comes as a byproduct of other metals rather than from dedicated silver mines. This limits how quickly supply can respond, even when prices rise. Strategic assets are defined by exactly this kind of constraint. In times of stability, silver's importance is easy to ignore. But when confidence in systems weakens, when inflation rises, debt expands, and trust erodes, silver quietly reasserts its role. It doesn't need promotion or hype. Its value emerges naturally when people seek something real, essential, and enduring. That is why silver is strategic. It stands at the crossroads of history and the future, serving as both protection and opportunity for those who understand what it truly represents. The silver market is approaching a critical imbalance, one that develops quietly but resolves violently. Demand for silver is no longer driven by speculation alone. It is being pulled forward by structural, long-term forces that are reshaping the global economy. As technology advances and energy systems evolve, silver has moved from being optional to essential. This shift is not cyclical, it is foundational, and it is accelerating faster than most people realize. Across the world, silver consumption is rising in industries that cannot function without it. Solar energy relies heavily on silver's unmatched conductivity, making it a core component of the global push toward renewable power. Electric vehicles, advanced electronics, medical devices, and high-performance computing all depend on silver for efficiency and reliability. These sectors are not shrinking, they are expanding aggressively, supported by government policy, corporate investment, and consumer demand. Every new innovation quietly locks in future silver usage. At the same time, the supply side tells a very different story. Silver mining is not growing in proportion to demand. New large-scale discoveries are rare, and developing a mine takes many years, often more than a decade. Environmental regulations, rising energy costs, and geopolitical uncertainty add further pressure. Unlike other commodities, silver production cannot simply ramp up when prices rise because most silver is mined as a byproduct of other metals. This means supply is largely inflexible. Even in the face of rising need, this widening gap between demand and supply creates tension beneath the surface of the market. Silver used in industrial applications is often lost permanently, not stockpiled for resale. That reduces available above-ground inventories over time. Meanwhile, Investment demand can surge suddenly during periods of economic stress, pulling even more silver off the market. When both industrial users and investors compete for the same limited pool, price stability becomes impossible. Markets eventually respond to reality, not narratives. When supply constraints meet relentless demand, the adjustment does not come slowly or politely. It comes through sharp repricing that forces balance back into the system. Silver has followed this pattern repeatedly throughout history. The current setup reflects the same conditions, only on a larger, more global scale. Those who understand this imbalance early see it not as a threat, but as a signal that a major transition is approaching. The silver market appears calm on the surface, but beneath it lies a structure built on confidence rather than physical reality. Most people believe silver trades like any other asset, with price determined by natural buying and selling of the metal itself. In truth, the majority of silver trading happens through paper claims, contracts, promises, and derivatives that represent silver, not the metal in hand. This system works only as long as trust remains intact. The size of the paper silver market has grown far beyond the amount of physical silver that actually exists and is readily available. Multiple parties often believe they have exposure to the same ounce of silver, even though that ounce cannot be delivered to everyone at once. Under normal conditions, this imbalance stays hidden because few participants ask for physical settlement. Most simply roll contracts forward, satisfied with paper profits and losses rather than real delivery. Problems arise when confidence shifts. During periods of financial stress, inflation, or currency instability, investors stop trusting promises and start demanding the real asset. When that happens, paper claims are tested against physical availability. If enough participants seek delivery at the same time, the system faces a constraint it cannot paper over. No amount of contracts can create metal that does not exist. At that moment, the market is forced into true price discovery. Silver must be repriced high enough to discourage demand or to pull hidden supply back into circulation. This adjustment tends to be sudden and aggressive, not gradual. History shows that when paper markets lose credibility, physical assets respond with sharp moves that catch most people off guard. The illusion of abundance disappears almost overnight. This is why the paper market cannot suppress reality forever. Systems built on leverage and trust function smoothly until they don't. When they fail, the transition is swift and unforgiving. Understanding this dynamic is not about predicting a specific date or event. It is about recognizing structural vulnerability. Those who see the difference between paper exposure and physical ownership understand that when confidence breaks, silver's value is no longer defined by contracts, but by scarcity itself. Major financial shifts rarely announce themselves loudly. They begin quietly, in moments when attention is elsewhere and confidence feels comfortable. The biggest opportunities in markets are formed not during excitement but during indifference. Silver is a perfect example of this pattern. While headlines focus on trendier assets and short-term movements, important positioning is happening away from public view. Those with experience and long-term vision do not wait for confirmation from the crowd. They understand that by the time an asset becomes popular, much of the upside has already been captured. Accumulation happens when prices are stable, sentiment is dull, and patience is required. This phase feels boring to most people, which is exactly why it works. Silence is often the signal that something meaningful is developing. History consistently shows that dramatic price moves are preceded by long periods of consolidation. During these phases, ownership shifts from impatient hands to those willing to wait. The market quietly transfers control without noise or celebration. When the breakout finally occurs, it feels sudden to the public, even though the groundwork was laid long before. Silver has followed this cycle repeatedly across decades. When attention eventually arrives, it arrives all at once. Media narratives change, analysts revise projections, and public interest surges. At that stage, availability tightens, spreads widen, and access becomes more difficult. What was once ignored becomes urgently desired. Those who waited for certainty find themselves reacting instead of benefiting, often forced to make decisions under pressure. Understanding this pattern is not about predicting headlines, it is about recognizing behavior. Markets reward patience and foresight, not urgency and emotion. Positioning early requires conviction during quiet periods and discipline when nothing seems to be happening. That is why the most significant gains are often made before the story is widely understood, when the opportunity is still invisible to most and the conditions for a major shift are already in place. In financial markets, timing often matters more than being right. Many people can agree on an idea, but only those positioned at the right moment benefit from it. Silver has a long history of moving in sharp, decisive phases rather than slow, predictable trends. It spends extended periods doing very little, testing patience and conviction, and then it moves with speed that leaves little room for hesitation. These rapid moves are driven by changes in behavior, not gradual adjustments. When confidence shifts or pressure builds, silver does not wait for consensus. Prices can rise dramatically in a short period, compressing years of movement into weeks or even days. Those who are already prepared experience clarity, while those who are not are forced into rush decisions, often at unfavorable levels. Opinion offers no protection in these moments. Being aware of silver's potential is not the same as being positioned for it. Many people recognize opportunity only after it becomes obvious, when risk feels higher and choices are limited. By then, emotion replaces strategy, and discipline gives way to fear of missing out. Timing separates foresight from reaction. What makes silver particularly unforgiving is that its strongest advances tend to occur when access tightens. Physical availability shrinks, premiums rise, and liquidity becomes uneven. At that point, waiting for a better entry is no longer an option. The market has already shifted, and the terms are no longer favorable. Prepared participants move from decision-making to management, while latecomers scramble for exposure. Understanding timing is ultimately about respect for market behavior. Silver does not reward hesitation once momentum begins. It rewards those who act before certainty appears and who accept quiet periods as part of the process. When the move finally happens, it is swift and decisive, and the window to act closes quickly. Those who understood this ahead of time are not surprised, they are ready.